Hey everyone, welcome to the show. Today I have two special guests from JC Clark Opportunity Fund. That would be Martin Braun. Martin was featured in my original book, Market Master, was released in 2016, as well as Veeral Khatri, who is Martin's now colleague, who's a co-portfolio manager in the Opportunity Fund. Welcome, gentlemen.
Good to be here.
Yeah. Thanks.
The fund has done exceptionally well. It might not be known as well in the retail investor community, but it absolutely should. First and foremost, for its long tenure, Martin, you go all the way back, starting the original Adderley fund as it was named in 1999. So you have a 25-year track record of compounding 11% annual returns. And so that would mean someone investing, let's say, $1 million back in '99 would have turned that into 13 million today. So that track record, the resilience on the street, and just keeping up that compound return is exceptional. Martin, for those who don't know, tell us about the early beginnings of the Adley Fund. If you start about why you named it and how you named it first, that'll be great.
Yeah, thanks, Robin. Yeah, I was a partner in a firm called Gluskin Sheff. It was a very dynamic firm in the late 80s and 90s, and toward the end, wanted to start a hedge fund there. But the senior guys didn't see it that way, and so we developed an exit strategy that allowed me to start one on my own. And so at the end of '99, I named it Adderley based on my children's names of Adam and Alyssa. ADALY became the new fund. It was birthed on January the 1st, 2000. From the start, it was an opportunistic fund that delved in a lot of arbitrage, which at the time was a very high margin business. And over the next 2.5, 3 years, arbitrage spreads narrowed, and we broadened the focus of the Opportunity Fund to include just about anything that made sense. So it was a totally open-ended situation where I could go long, I could go short, I could do arbitrage, but I also do other things, like just basically buy stocks I liked and shorted the ones I didn't like. And then over the years, as the investment climate evolved to include things like royalty trusts and income trusts, we'd move in and out of that stuff too. And yeah, it's been a long, long period of time, as you say, 25 years. The complexion of the markets change all the time, and the fund's basic philosophy has changed with the markets.
And even before then, Martin, in my book, I remember you said that you used to be a value investor and then you converted to a growth investor. Can you tell us that story?
Yeah, I guess like a lot of guys of my vintage, having studied markets from the Ben Graham books of the 50s and into the 60s and 70s, value seemed to be the predominant way to look at securities. You try to figure out what the business was worth and if you could buy it in the market for less than that, and the bigger the discount, the better. That's what made sense. You did models and to support all that, and I think over the years, the market's now more like winners and losers, and a lot of the losers look like they're value, but they're really value traps. So I've become increasingly skeptical about the analysis based on pure value alone. I think growth is predominant today, and I think with the passage of time, it's going to be more so. It's a very fast-moving economy that we're living in, and some companies can keep up and stay ahead, and others fall by the wayside, and unfortunately, there's a lot more losers than there are winners. So it just makes a lot of sense to focus on the winners, which is mostly the growth stocks.
And those arbitrage opportunities early on, you obviously weren't seeing the same returns years later, but what were some of those early arbitrage opportunities?
Yeah, the one that comes to mind was a creature that was created by some bankers around the notion that Bell Telephone owned a big chunk of Nortel, which at the time was a very valuable company. Of course, many years later it went out of business, but that the shares of Bell did not reflect the value of the Nortel position they held. So they created this thing called Teleclone, and they floated it on the market. And unfortunately, it didn't work out. They issued it at around $30 a share. And the idea was that you would be long Bell and short Nortel. They wrapped it into this public vehicle, and instead of the spread narrowing as the recognition of the Nortel value inside Bell was quit. Let me start again. There was an implied value of Nortel that was heavily discounted. Teleclone's idea was that discount would narrow. Unfortunately, the opposite happened. The discount widened, and because the position within Teleclone was highly leveraged, as the differential actually went wider, not narrower, the leverage worked against Teleclone, and Teleclone shares went from 30 to 5. And at that point, we actually stepped in, and they eventually reversed and went from 5 back to 30. So that was a big win in the early days of the arbitrage.
And what were some of those early growth companies that you were investing in the fund?
Well, you're asking me for something that happened a long time ago. I think that one of the better plays we made was toward the end of the meltdown in 2000 through 2002, and your audience might recall that after a very big run, the market collapsed in the early part of 2000 and went through a period of 2.5 years where everything was being thrown away. We found a lot of companies selling for less than cash, so we accumulated a portfolio of companies, mostly U.S. companies, that had at this point been destroyed and were now trading at something like 30 or 40% of the actual cash, never mind the business, if there actually was a business. So we would very carefully pick through the carnage and came up with about 20 different names where we felt the boards were somewhat proactive and would do something about this huge discount. Basically shut down the business, pay out all the cash, and call it a day, that kind of attitude, which was a lot better than actually blowing the money on some, harebrained idea. There were a few of those too. So I think our selection criteria was pretty good, and in the end we made a ton of money, because if you're buying something for 30% of cash and in the end they pay out the cash at say 90 cents on the dollar, you've made 3 times your money.
Yeah, the reason why I asked that question is because with a 25-year tenure and with markets changing, let's say every 5 years, you're evolving with the market. If you look back at 99, 2000 till now, 2024, Martin, how has the Adley fund, now the Opportunity Fund, how has it evolved its strategy?
I think that a lot of what we did in the early days is part of another time and will not recur. They say history doesn't repeat itself, but it rhymes. And I think that's the best one could say about the times that I saw way back when. Today, the fund is a much cleaner fund. In order to articulate it, I would simply say it's a long-short equity fund that focuses on Canadian small to mid-cap securities that have been overlooked by the broader market.
So this is a good segue. Veeral, let's talk about your introduction to the fund. I think you joined on J.C. Clark in 2006, I believe, as an analyst. Tell us about your journey from analyst to then joining Martin as the co-portfolio manager.
Yeah, so 2006 I came on full-time at J.C. Clark, straight out of undergrad. I had done a couple internships with J.C. Clark, so I was kind of familiar with the team and the process. And really from that 2006 to 2008 time period, I focused a lot on equity research, bottom-up research, and during that period we also made some heavy bets against the mortgage lenders and some of the housing related stocks that were obviously in a bubble. And so it was great for me to get that sort of experience looking at both longs and shorts at such an early point in my career. Over the ensuing couple years, my responsibilities increased. I went from an analyst to an associate portfolio manager. I was working on one long biased fund. At the time, it was called the Canadian Value Fund, with another PM here. And Martin brought his fund along to J.C. Clark in 2014, I believe, 2013. And we noticed that there was quite a bit of overlap between the two funds, and noticed that, in Canadian Value, we were also looking for kind of growth-oriented Canadian companies in that small to mid-cap space. And so in 2018, 2019, we decided to merge the two funds together, and that's how Martin and I started working more closely together. And so today, we're both co-managers of the fund, and that's sort of how we kind of came to be, and how the Opportunity Fund is where it is today.
And Veeral, were you schooled originally in the value investing school of thought, or was it growth at the onset? Tell us about that.
Yeah, absolutely. I think, when I first started, I was very much, I probably paid too much attention to valuation multiples. And, again, the risk with doing that is sometimes you get caught up in value traps. And, the flip side to that is also, if you're too sensitive on price, sometimes you miss out on good stories on the long side, because they may be trading at a premium multiple, and that may look expensive to you, but over the long term, that multiple can probably even go higher. So initially I did start off with a very value sort of bent, but over time, you see how the market is evolving, and as Martin alluded to earlier in his comments, you're starting to see that there is more of a premium placed on growing companies that have good things happening to them. And so I think over the last few years especially, I've learned to be a little bit more or a little bit less price sensitive, shall we say, and be willing to take positions in companies that may look expensive on the surface on earnings this year or possibly even next year, but if there's a long growth story ahead, then those are still good bets over the long term. So I've certainly had to evolve to more of a growth mindset. And today I think if I had to kind of use a phrase to describe our style, I think growth at a reasonable price is probably the most appropriate phrase we could use.
Yep. Gentlemen, 2024, we're at the tail end. We're in December. Can you reflect on the year that's almost wrapping up, the market in general, and your fund as well?
Do you want to take this?
Sure. Why don't I talk about the fund a little bit? So as of right now, we're up in our year-to-date performances in the high teens. Excuse me. Now it's important to keep in mind that Opportunity Fund is a long-short equity fund, so we're not 100% exposed to the market. For most of the year, I would say our average exposure was probably around 70%. So being up in the high teens, around 18% year to date, with average market exposure of 70% is not bad. I would say overall we're quite pleased with how the fund performed this year. I think if we look back at some of our winners, we benefited from some takeouts in the fund earlier this year. We had a fairly decent sized position in Park Lawn, which is a funeral home and cemetery business that was very undervalued, and we acknowledged that, and there was a takeover at a large premium. Another company that we had that was a takeout was a company called Copperleaf Technologies, a really exciting software company, excellent growth potential. We were almost a little bit disappointed that it got taken out, because we thought we probably could have made more money over the long term had it remained public. So we certainly benefited from a few catalysts like that, and then overall, just generally our stock picking was quite good this year. If I were to use baseball terms, I would say our batting average was quite good this year. Maybe our slugging percentage could have been a little bit better, meaning maybe we could have sized some of our bigger winners even greater and made more money when we were right. But I think overall, generally, I think we're quite pleased with how the fund is shaken out. Maybe Martin, if you want to talk about just the market and your thoughts on that.
Yeah, I think we're not market guys. We're more stock pickers, so we don't think about the market in great depth, and we don't spend a lot of time reading commentaries and research on the markets writ large, global economies, markets writ large. That's in the background. Our primary focus is identifying companies that have been overlooked. We focus on, as I said earlier, small to mid-sized companies in Canada. We wish there were more great companies in Canada. I think part of the blame lays on our government and government policies going back generations, that we haven't evolved enough from being a branch plant economy of the U.S. There have been some great Canadian technology companies that have been birthed here in Canada. Unfortunately, when they get to a certain point, if they're really good, they get taken over. And so over the years, and the last couple of years have been good examples of this, there's been this hollowing out of really good small to mid-sized Canadian companies, mostly in the tech sector. And because we focus on Canada, because our information flow is really good up here, we get really, really good information and get to meet executive teams all the time. That's going to be our primary focus. So we want more great Canadian companies to look at and study. We wish there were more of them, but that's our primary focus. And yeah, they take a while to get discovered, which gives us a leg up. Eventually, if they're really good, the Americans discover them, and generally speaking, the American investment community pays more for companies than we do up here. And you can really see the volumes pick up and the stocks start to really scoot when the Americans step in. Recently, we've had a huge success with a space company called MDA, and back in the earlier days, it was a Canadian story that had limited traction, maybe a few missteps, but eventually it really caught some tailwinds and got going. And in the latter part of the year, it's pretty obvious that the Americans are well behind it. And I think part of it is SpaceX, which is such a big name in the U.S. So everything's space. It's like everything AI, but everything's space now. And the Yanks have discovered this MDA up here in Canada, and that's kind of our secret sauce, if you will. Find the companies at an earlier stage in their development and build a big position, and then wait for the rest of the world to figure it out.
There's absolutely few tech companies that get to a large size, right? There's exceptions like Shopify and Constellation Software and some others, but to your point, Martin, occasionally they're taken out early, and then you're on the hunt again for new opportunities for the fund. If we can go into the information flow, can you walk us through those sources, and are any of those available to viewers of the show, for example, or are these just Bloomberg Terminal and things like that are subscription based? If you can walk us through information flow.
You want me to? Well, it's kind of tricky, Robin. I mean, in terms of idea generation, a lot of our ideas are internally sourced. We tend not to rely on the sell side for too much in terms of actual idea generation. We'll use the sell side to confirm a thesis or get some data points, but actual generation usually happens within the boardroom here. In terms of information, it's really case by case. I think we're a small firm, so we don't have a ton of resources and proprietary data sets that we would love to have at some point, but really I think we just leverage our networks as best we can to get certain pieces of information, and if there is one industry that we're spending a lot of time on, we'll look to subscribe to specific publications that are kind of narrowed or have a narrow focus in that area. So so it's really by a case basis. We don't other than the obvious Bloomberg terminals and that sort of stuff. There's not really much else we rely on.
Do you still have analysts who will comb through CDAR, for example, which is publicly available, for press releases, financial statements?
That's always available to the general public, but doesn't really add a lot of value to what we do. I guess one of like I said earlier, the biggest sources of information and comfort is being able to speak to the management teams. I think the average retail guy who maybe works for a living and doesn't have that kind of time on his hands is not able to access like we do, because this is what we do. So sometimes we'll see them in their offices, sometimes they come to ours. Increasingly, it's a lot of Zoom and Teams calls, but it's great when you're actually in the same room with the CEO and CFO and get to look in whites of their eyes and see what they're really about. And after all these years of doing this for a living, I think I've gotten fairly good at telling whether somebody's legit or not. And there are a lot of people in executive positions who talk the talk, but they don't deliver. And it takes a while to really be able to tell the wheat from the chaff, so to speak. That's where experience really comes in. Is you meet so many people, thousands of people over 25 years and more, and after a while, there's some telltale signs that they're just blowing smoke up your what, and then there's some guys that are legitimate. They're just incredibly good operators, executives, leaders, motivators. They pull a team together, and they're all motivated to win. And when you meet a management team like that, it's very exciting. You're onto something. So yeah, I would say information coming directly without them breaking any securities rules. That kind of information is invaluable.
Martin, have you gone into a meeting with a CEO or management team? You were initially bullish on the company through internal research, public data and knowledge, but post interview, you walked out saying, "I'm not going to invest in the company." And if that was the case, what were those telltale signs or red flags?
Yeah, no doubt it's happened on countless occasions, although I can't recall any off the top of my head that I would even mention by name publicly. But the telltale signs would generally be that in previous conversation something was alluded to, and in this conversation something's changed. You don't want to hear that. It should be a consistent message from one meet to the next. So that's one thing. The other thing is just inability to answer questions directly, and sort of talking around the question, or coming at him with a question out of left field he wasn't prepared for, or it could be a she too. So I guess they is the new moniker. But they just seem to dance around, and when you give them a question from left field that they didn't see coming, they stumble and fumble around and kind of look a bit askance because they weren't ready for that one. And a good executive and CEO should be ready for just about any question, and actually light up when he gets a question that's he hasn't fielded before. One of the things I learned at Gluskin Chef so many years ago, and Ira Gluskin, one of the founders, was like a mentor at the time, was we'd sit in meetings and he'd wing these questions out of left field at guys, and they always thanked him after the meeting. They said, "That was a really interesting meeting we just had. I really enjoy the kind of questions you asked." And I think if you don't ask a smart question, you're not going to get a smart answer. If you ask a dumb question, you're going to get a dumb answer. So I think a lot of the back and forth between people like Veeral and I and management teams is the quality of the questions we're asking and how we assess the answers.
And what other principles did Ira pass down to you, Martin?
What else has Ira passed on to me? How to dress better.
That helps in meetings, right? Have there been cases, though, where you weren't able to secure that CEO or management meeting, and you still pulled the trigger anyways on adding the company to the fund?
Yeah, sometimes they're just not immediately available, and we feel like it's getting away from us, so we need to act.
So let's stay on the long side of the fund. I think we would love to hear for a recent stock selection, a recent company that added to the fund. What was the process from A to Z, from start to finish?
Sure. Well, I can talk about Blackline Safety, which is a relatively recent addition to the fund. We probably initiated a position about several months ago. But this is a company that we've had some history with. We've been following this company for a while and always thought they've had a great product, great management team. But the biggest issue with this company was they just weren't profitable yet. You know, it's one of those high growth companies that was still burning or losing money on an EBITDA basis, and so there was always the potential that they would have to come to market and raise money, and weren't financially sustainable yet. Fast forward to just very recently, we noticed that the company has started to put up some really good quarters, and the growth on the top line has always been there, but now they've hit this critical inflection point where they're actually profitable on an EBITDA basis, and they're continuing to scale. So for us, that's a key kind of catalyst, key turning point for us. So we brushed up the file, we got reacquainted with the business. We spoke to several sell side analysts just to kind of get a lay of the land, understand the sentiment. We participated in management calls to kind of hear the management speak and reinforce our view that the business is quite good. And then we did some number crunching. We looked at the growth trajectory of the business and where EBITDA margins could potentially get to, and we realized that yes, on next year's basis the stock still looks expensive on an EBITDA basis, but within a few years that EBITDA number should be quite a bit higher, and on a 2-year basis it's actually looking quite reasonable. So that's an example of one where qualitatively it kind of checked all boxes for us. And then quantitatively, from a valuation perspective, it looked quite attractive as well.
On the short side of the fund, walk us through a recent short and why you selected it. What are the parameters?
Yeah, so we got to be a little bit careful when we're talking about shorts, because sometimes we like having access to management teams and both from.
We don't have to name names.
Yeah.
If you can just walk us through the framework so you understand the selection process.
Yeah, so I would say generally shorting has become very difficult. When I first started at JC Clark, 17 years ago, it was a lot easier to find shorts, and shorts based on valuation worked. Nowadays, we find you can't just short based on valuation, because if you're shorting based on valuation, chances are you're shorting a really good company that's trading at a premium valuation. And so we have to be a little bit careful with how we go about identifying short opportunities. And what we found that actually works is identifying companies that are hitting a soft spot in their business. Okay, so let's just put valuation aside for a second. But a company that has maybe been riding a very strong earnings growth wave, and then something has inflected to the downside. And I think one example of that is a Canadian company in the recreational product space. I won't name names, but there's a company that had a really strong earnings trajectory coming out of COVID, traded at a pretty reasonable valuation multiple, and then all of a sudden, the kind of the taps shut off. People are not spending as much on recreational products as they were during the COVID period, and the stock needs to more accurately reflect that the outlook is softening quite significantly. And so we shorted, we took a short position in that company and made quite a bit of money, and subsequently covered it. There's another recreational product company in the U.S. that we still have a short on, which is, we're okay, I guess, identifying the name for a U.S. company, but it's Harley Davidson. Again, you can look at it from the long side and say, wow, it's really cheap, it trades at a low valuation multiple, but there's an example of a company that's facing not only cyclical concerns, but secular issues as well. So on the cyclical side, you have some of the same issues about overspending during COVID, and now you have this hangover period. But from a secular standpoint, how many 20-year-olds or 30-year-olds do you know that ride a motorcycle or are keen to own a motorcycle?
It's noise pollution. We all complain about it.
Right. We found that and there's interesting stats that you can get online just about the newer generations and the younger generations. This demographic is just not interested in motorcycles as much as perhaps the Gen Xers or the baby boomers were. So there's some serious cyclical and secular concerns with this company, and so we've initiated a short position several months ago and are up on it, and we still maintain that short position today.
And short opportunities obviously broaden during market downturns like we saw in the great financial crisis. Harley Davidson or Hog, I think, saw its greatest downturn of its history. That would have been a great short then as well in 2007 and 8. What was it like during the pandemic, during, let's say, March, April 2020? Was that a good opportunity? Were you seeing more short opportunities?
Well, the market collapsed once COVID became the biggest driving force in the markets to the downside, and market just completely collapsed in those first few months. And by May of 20, it was really bad. Stocks were trading at extraordinarily low prices. At that point, we were buying. We had been crushed like everybody else. We were down at that point maybe 20-odd%. And then you had this stunning reversal. Unfortunately, we did do a lot of buying back then, and then everything turned around, and we had a huge year. I've never seen a year like this, where at one point you're down in the 20s, and by the end of the year you're having one of your biggest years ever. So
it was a V shape, right, Martin? It was a complete V.
It was
right, down and up.
It was a really crazy V, yeah. And there were stocks that we bought in May. You look back now, and what were people thinking? Stocks that have gone up 5-10 times since, and yeah, but that's the markets of today. Highly volatile and subject to the popular delusions of crowds and so forth.
And you touched on this before, but it's crucial to get position sizing right as well. What's the composition of the fund? Is it concentrated, I would assume? How do you determine position size?
Our typical position is 4%, 4 to 5, which allows for 20 or 25 stocks. And then you have shorts, index shorts or outright shorts like Hog, which will get you down to 90, 80, 70, 60, 50 net, depending on how short you are. But yeah, theoretically, 4 to 5 would be a full weight. But when we really like a name, we're happy to go to 8, and it might even go to 10 if the stock goes up. One of the things we have to maybe get better at is having more money in our best ideas. 4 to 5 is good if the stock goes up 50%, but 8% would have been even better, right? So we have a tendency to stop at around the 6 to 8 mark. We'll introduce positions at the 2 level, so we'll have maybe 3 or 4 at a 2% weight, and maybe a few over the 5-6 area, but most of them sort of fall within that 4% area. And you don't want to have too many more than 20 or 25 in total, because there's just the 2 of us, and there's only so much mental bandwidth here.
What are the companies, if you look back in history, let's say the past 10 years, that have gone all the way up to the 8% threshold, Martin?
Well, currently we have.
Well, why don't we talk about Pollard?
Yeah, sure.
So currently we have a position that's close to 8%, and this is a position that was probably even larger than 8%, maybe about a year and a half ago. But it's a company called Pollard Banknote. They're one of only 3 companies in the entire world that produce instant scratch lottery tickets. It doesn't sound like a very sexy or exciting business, but instant scratch lottery tickets is very much a stable growing industry. Ticket sales at the retail level have averaged about 6 to 7% growth over the last 30 years. It's an oligopoly. There's huge barriers to entry. Lots of great reasons why this is a high quality business. And a couple of years ago, they were facing some issues with input prices going up. So the biggest inputs to produce lottery tickets is paper and ink. And for years and even decades, paper and ink prices have always been kind of very stable and predictable. And then during COVID, you had such great supply chain disruption, you had suppliers pushing in crazy price increases, and all of a sudden, like literally overnight, their paper and ink costs went up substantially. And because they have fixed price contracts with their customers for the lottery tickets, Pollard was having to eat that margin, and it basically eroded all the profitability from their core printing business. The stock got crushed. It went from basically a high of $60 down to $16. Still thought this was a fundamentally good business, and we stayed in close contact with the management team. And from those conversations, we understood that these contracts that they have with their customers are rolling over every 2 to 3 years. And when they roll over, they're going to push through quite a big price increase to offset some of that cost inflation. And we just felt like the market wasn't fully reflecting that potential at $16 a share. So we backed up the truck, and it was the largest position in the portfolio. And over the ensuing 12 to 16 months, the stock got as high as $38. And today it's kind of given some of that back. It's in the mid-20s for other reasons unrelated to the cost issue, but that's probably an example of where we saw an asymmetric return profile and decided to make it an outsized weight.
I think a lot of people are stuffing their Christmas envelopes with some scratch and win tickets right now as we speak, right, and putting under the Christmas tree. What would you say is your average holding period in the fund?
There's no real average. I mean, there is an average, but it varies from. It could be a short-term trade of less than 90 days, or it could be a 5, 6, 7-year hold as well. I don't know what that would average out to. So there's no real good answer to that, but it really depends on the situation. Like right now, we have a few positions that we are in for a trade because at the end of the year, there's a lot of tax loss selling. So there's a few names that we think will rally into the new year because of that that tax loss effect. Those positions will probably be gone within the next 60 days. But then there's other things that we've held for a very long time, including Pollard. I think we have one position called North American Construction, which we largely purchased during that period you were referring to earlier, the early 2020 period when things got destroyed. North American has now been with us, I guess, going on 5 years. It's quintupled since the low. Just another example of what happened, how silly it got back then. So, it's really all over the map.
Let's pull on that short-term trading thread. You mentioned that you entered some new positions because they've been kind of clobbered by obviously tax loss selling at the end of the year, and you expect a rebound into Jan, maybe even Feb. What other reasons would you enter short-term trades in the fund?
Oh, well, sometimes a company will come to market with an issue that gets heavily discounted in order to clear. And then after the issue has been priced and the books close, it'll rally back up to where it was before. Sometimes the market gets wind of this issue is coming and they start selling off the stock ahead of the issue. And then they price it in the hole, and so there's a big recovery effect. There's one company called Propel, which is a very good company, and we still own it. It had rallied dramatically from, call it 7 to 32, 33. And then there was some talk that the company was going to have to do a financing, and we felt that it might come at a very nice discount, and it did. It came at pretty much a 20% discount to where the stock had been before word got out. And then sure enough, a few weeks or a month later, after the deal had been done, the stock was not only back to where it was, but even higher. We had put in a little more than we would have normally held, so the excess we let go, and that happened very quickly. We're talking weeks, so that would be one example of where where we might only be in it for a short term. Sometimes we might be in something because we're expecting something to be announced soon. Like, for example, there's a company called Enerflex, which was rumored to get included into the index. And, when it does, all the index buyers have to, at some point, buy that position. So that's increased demand for the security. We knew this was coming, and I don't remember exactly what we did to position ourselves for that, but a lot of people might have, like us, owned it ahead of that, and then maybe sold some into the news. I think we sold some, but it's still one of our favorite positions, and we still own it. So yeah, there's all kinds of stuff that happens in the market that would prompt you to think of something as a short-term trade. But that's why it's called an opportunity fund. You just go where the money is.
Absolutely. And talking about going to where the money is, you entered the U.S. on that Harley Davidson short. Why would you enter the U.S. for a long? And have you done that recently?
Yeah, we have. I would say recently there hasn't been too many new positions that we've initiated in the US on the long side. I think we just generally are finding better value in Canada. The other challenge that we find with the US is just having access to management is a little bit trickier. And so, we obviously take a lot of pride in our due diligence process. And as Martin talked about, we like, sitting in front of a CEO, seeing them face to face, having regular contact, and we just find generally, in the U.S. when we're dealing with U.S. companies, it can be a little bit trickier to establish that rapport. So that, kind of, sort of steers us a little bit away from U.S. stocks. But that being said, we're obviously open to looking at ideas. It's just right now we haven't seen a ton of compelling ones south of the border.
For companies that you initially thought you'd hold for the long term, let's say it was in the long term bucket, but you sold prematurely. Why did you sell? Why did you pull that sell trigger?
Yeah, so that gets back to the old value versus growth trade-off. I'll give you a perfect example. There's a company that trades on the TSX called Hammond, and it's been around quite a while.
Is that Hammond Power or Hammond Manufacturing, Martin?
Hammond Power.
Hammond Power.
So they're part of this whole electrification theme, and which has sort of taken off in the last. It's sort of one of the more topical, things of the last few years, like AI and Bitcoin. Electrification is right up there with those sort of themes and popular themes. So Hammond, after many years of really not going anywhere, was around a $10 stock for a long time. It suddenly triples to like 30 something when it came to our attention, and it was brought to our attention because this whole electrification thing was very impactful for Hammond, and their earnings, which had never been much of anything, suddenly took off, and it fully justified the move from 10 to 30. But it could also, if you extrapolated it, justify even a bigger move. So we caught up with the idea and bought some, and it went up 50%, and it went up pretty fast too. And at that point it seemed a bit expensive, so and maybe a little overly popular. So we just felt like, okay, it's a bit of a crowded trade in here, and we've made our 50%. Let's move on, and then it tripled. So it's really a perfect example of where you're at this sort of inflection point between, is this a short-term position or is this a long-term position? And sometimes you get it right and sometimes you get it very wrong, like in that case. So yeah, it's hard to make that determination. A lot of things that have gone up a lot have become extremely popular, especially with a lot of folks who don't really know what they're buying. It's going up, so they want to buy it. But other times it's very real. And of course, I should also say that after Hammond tripled, it then proceeded to drop by 40%. So It's all over the map, these things, and you can't beat yourself up if you just don't get it right. But I do believe that the lessons we've learned is that growth triumphs value.
Is there any use in technicalities of the stock chart and trying to read a stock chart, or is that just all hocus pocus?
Uh, yeah, I wouldn't call it hocus pocus, but I think like my own personal view, and Viral and I might, we don't talk about this subject very often, so I don't know how Viral would answer that, but I would just say that for me, it helps me make a better sell or buy, but these are short-term things, right? Like instead of buying something at 35, maybe the chart says I should wait for it to go to 32. Or maybe if I think that the stock should be sold and it's 37, the chart says, no, hold on till 40. That's about as much as I will give credit to charts.
So let's get into 2025. We're just about to enter the year. What are your thoughts on the market? What are your best ideas as we enter the new year?
Why don't you start with the market?
Well, again, like we had said earlier in our chat, we're not big market guys. The market's largely dependent on macro forces like the U.S. economy and other major economies like China's. It's also dependent on interest rates, to some extent currencies and commodities, and these are just large macro issues which we don't have maybe the bandwidth to tackle in any great intellectual deep way. So I would just say that we're a little concerned. Europe seems to be going through a very difficult period, and China as well. The U.S. is definitely the star at this point, but we're not sure how far that can carry the rest of the world. And rates are high in the U.S. and the real estate markets are soft. Commodities have weakened, which is not good for Canada. And there's a bit of a hollowing out with most of the money going into big cap tech. And so there's not a lot of breadth here. There's a handful of winners and a lot of companies that haven't made anybody any money. And so I think we're a little bit concerned with how much money there is to be made in 2025, but we've always been very good at picking stocks that somehow we get in early before everybody else figures them out, and all we need is a few good men, so to speak. If we can find 12 or 15 good names in 2025, and average weights of maybe we get a little more aggressive on weight size and we move it up to the 5-6 area instead of the 4 or 5 area. 12, 15 names at 5-6 a name, that could make our year. So I don't really have a strong market response to you because we don't have strong feelings about it. I wouldn't say we're outright bearish. I think we're just very cautious and we're just looking for those few good names.
I think you have more to say on the tough times that Canada is going through as well, Martin. Like we just lost our finance minister; she just outright quit. So I think Canada is going through a very tough time, and we're making Europe look like a cakewalk currently. What about the IPO market? The IPO market is basically dried up. Do you see that coming back in Canada anytime soon?
It doesn't look real good. I mean, there was an IPO about 4 weeks ago called Group Dynamite. It's trading below issue price, which isn't great for any other IPOs in the works. And this was the first non-resource IPO in a very long time of any size. It's a $2 billion company, so that's pretty big by Canadian standards, but I don't know, like, again, it comes back to this country and what kind of a country we live in and how entrepreneurial and how much we invest and how much the government encourages industry and, creating great new companies that are ready for the IPO markets. It's disappointing that there are more of them. We did have a bit of an IPO splurge a few years ago. Unfortunately, a lot of them came at fancy prices, or they just weren't very good companies. And within a year or so, most of them were seriously underwater. Some of them deservedly so, and some of them not so much. Actually, Copperleaf was one of those, the one that Veeral had mentioned earlier that eventually got taken over. Another one was called Kits, which is an online eye care company that, more again of being priced egregiously at $8 or $9 and then going at $2. But then eventually, like with the passage of time, it found its footing and it was in the teens at one point. So big reversal. So some of those stocks in 21 deserve to be crushed. Others were just overpriced, but the whole thing left a bad taste in people's mouths. Within a year or two, everybody who played on those was really pretty upset about the whole process, and I can understand why since then there's only been, like recently, this one IPO. So I'm not too positive on the outlook for IPOs in Canada.
And it's so true. The ill timing and a lot of these companies probably weren't ready to be public and might still not be. A lot of takeovers from private equity, and when they were taken over, they're taken over at prices that were below the IPO price in a lot of cases. And so that, as you said, left the sour taste in people's mouth. Martin, if you look back on the past 25 years, when was the last time when the IPO market in Canada, which is so dry, so bad?
There have been long dry periods, but this got to be right up there as maybe the worst.
And for a fund that's literally named the Opportunity Fund, you're looking for new, innovative companies that are primed and ready for growth, right?
Yeah. The more great Canadian companies that show up on public markets, the better for us. More to choose, rummage through, and yeah, no, I wish the capital markets in our country were more vibrant than they were. What can I say? We both feel the same way.
With that said, on a positive note now, positive conversation, what companies are you most excited about in Canada leading into 2025? If you can name, let's say, 3 to 5.
Yeah, sure. Why don't I name a couple, and then Martin, maybe you can talk about
Sure.
two more. So I guess Pollard Banknote, one we already kind of alluded to, but it's still a core position for us, and we think over the next couple of years, their core scratch ticket printing business is going to do very well. We also think their digital side of their business, the iLottery side, is going to continue to grow. And, there is some concerns that the market has around how competitive they'll be because that whole space is seeing more intense competition than it has in the past. But we think Pollard's offering is quite strong. Actually, myself and another colleague went to Winnipeg just a few months back to sit with the management team and focus specifically on their iLottery offering, and we came away quite impressed with their product there. So I think that one is a really good business. It's trading at 5.5 times EBITDA. One of the competitors in the space is a company called Scientific Games, and it got taken out by Brookfield a few years ago at 12 times EBITDA. So this is trading at basically half the multiple of its closest peer. And so we think there's lots of upside for that name. Blackline Safety is another one that we mentioned. Think the outlook there looks good. Another interesting one is this Brookfield Business Partners, ticker BBU. This is basically the private equity arm of Brookfield Corp. So when you buy a share of BBU, you're effectively buying a stake in some of those private companies that BBU is invested in. And, they've got some really great franchises in there. They own a company called Sagen, which is the largest private residential mortgage insurer in Canada. It's the old Genworth. But the crown jewel asset within BBU is this company called Clarios. And Clarios is the largest automotive battery manufacturer in the world. This is not electric vehicle battery. These are the low voltage batteries that you find in the hood that power the internal electronics of the car and power windows, power doors, all that stuff. So every car, regardless of whether it's a combustion engine or hybrid or electric, has to have a low voltage battery in it. So Clarios dominates this market. 1 in every 3 cars in the world have a Clarios battery in them. And so this is a company that BBU owns a stake of. And based on our math, we think that Clarios alone is worth $28 a share, which is like 85% of the share price, and which means we're getting the rest of the businesses that BBU owns for a very cheap price. And the interesting story with BBU is that we think the management team is looking to monetize Clarios at some point in the near future. And so, we talk a lot about catalysts and what's going to take a stock from being undervalued to fairly valued. We think that this Clarios monetization is a good example of a value unlocking catalyst. So I would say those three are kind of some key names that we're focused on. Martin, I don't know if you wanted to talk about any others, but
Yeah, I'd mention Algoma, which recently the shares have dropped because of Trump's comments on tariffing Canadian steel and everything else. So we're not sure that's ever going to actually happen, because the people that buy Algoma steel are typically American companies, and it doesn't really make a lot of sense, but we'll see how that plays out. Nonetheless, the stock's been very strong up until the recent comments about tariffs. It's now not only inexpensive, but it's nearing the end of this complete transition from being a blast furnace steel producer to an electric arc furnace steel producer, and the valuation between the two is differential is stark. Guys who make steel with blast furnaces trade at 4 times, and guys like Nucor who make it using scrap steel trade for like 8 times. And so the lift when next year the company transitions to this new production is we expect a big lift. But ultimately we think Algoma is going to be taken over by someone else. Every other steel company in Canada is gone. This is the last one. It's the shareholder base is largely American. It trades on the U.S. market. We think there's about a 100% lift here once the dust settles. The other thing to be said about Algoma and this talk about tariffs is because the Canadian dollar's dropped so much, Algoma is a huge beneficiary because all its costs are in Canadian dollars and all its revenues are in U.S. dollars. So it's actually a winner in all of this. So we'll see what happens with the tariff thing, but there's a lot of upside on this one. There's another stock we don't really talk about that much, but it's sort of a neat stock. We're up a little bit. It's called Keg Royalty Units, and basically this thing it went public a very, very long time ago as an alternative funding vehicle for the guys that owned Keg. They created this royalty structure to help fund their growth, and that was many, many years ago. Today, Fairfax controls Keg restaurants, but the royalty structure still trades on the market. Hardly trades at all, but it's out there and it trades on the market. And all it is you get a royalty on Keg sales. And, Veeral and I have done the math. It just doesn't make any sense for this thing to be out there. Fairfax should bring it in. They'd save themselves a lot of money, and if they did, there'd probably be a 30% lift on the stock. And it's already happened, I think, a year or so ago. There was A&W or...
yeah.
They had the same thing, and it got taken out, and I think it's inevitable. We don't know when, but... And then I guess, we have a couple of specialty energy service or energy-type stocks. I don't want to go into great detail. We're not really big on oil and gas and this sort of thing because it's all driven by commodity prices. We don't like to get into that too much. But, we have one little junior oil and gas company called Saturn, which is trading for less than a multiple of 2. I think it's now down to 1.7. And their free cash flow yield is something like 35%. It's crazy cheap. Mm-hmm. So it's the only one we have in the oil and gas production area. It's not an area we really like to be in a lot, but that's just one name I'll throw out there. And then in the service field or service area, we have 2 names. One's called Enterprise and one's called Source. Enterprise makes it's diversified. It has a rental business, a tool business, a service business, and the real cool product they have is a gas turbine. which is much better than diesel. They basically take the gas that comes off the hydrocarbon stream and they inject it into the turbine to drive. That's where the electricity comes from. The emissions are much lower, 85% cost savings. It's really taken off. So that's what Enterprise is about. The other one is called Source, and that's a fracking sand company. They have their own pits. Their whole distribution system is, from soup to nuts. They own the whole thing, and they're like a huge frac sand producer and supplier to the Western Canadian Sedimentary Basin. Again, really, really inexpensive. But, we're talking 2.5, 3 times. So, I mean, we know that it's not a huge selling feature because everything energy in Canada is like 1, 2, 3 times. And we're just hitting our head against the wall if we think it's ever going to be much more. But these companies are very, very good companies, and they're all doing very well.
Was there a time, Martin, when you had a bigger allocation to the Canadian oil and gas industry? And if so, when was that time?
Well, Veeral and I have never really had a big weight in the energy field. But, I do recall way back in like the early 90s when I was still with Gluskin Sheff, we had a massive weight. But those were different times. There was a theme at the time that worked, which was that the majors were getting out of Canada and they were divesting non-core properties, and all these very smart entrepreneurs from Calgary knew that the value of these properties was multiples of what the majors were dumping them for. And so it was an incredible time for those guys. They'd create a company out of thin air and buy a piece of some asset that a major would have no use for, pick it up for $10 million and turn it into a public co. Within a year and a half. It was $100 million. So they just took full advantage of majors not really knowing or caring what these things were actually worth, and that was a theme that played out for a number of years. And Gluskin Sheff made a ton of money in the early 90s, but. And then there was another period in time when a lot of companies converted to royalty trusts. So there were a bunch of junior companies. They weren't given any credit for anything, and they were trading at lowly multiples. And there were a bunch of royalty trusts like Pengrowth and ARC that had been around forever, and they traded at 130% of NAV, whereas the juniors were trading at 60% of NAV. So the juniors were going, well, why don't we just turn ourselves into royalty trusts? So they did, and everybody who played on that theme made a ton of money. But today, when I'm looking at the patch and looking for something that would be comparable to those two periods, there's really nothing out there.
There's no real opportunity right now. Gen AI, and let's talk about ChatGPT. Is there any tinkering going on at JC Clark and how Gen AI can help with the stock research process?
So funny anecdote, Robin. We were playing around with not ChatGPT, but Google's LM Notebook service, and so we got introduced to the function where you can upload any sort of report or article, and then it will summarize it in written form, but it will also generate a podcast with 2 AI hosts, and they're talking
Interesting.
about the topic, and it was just more for the novelty of it, and we were quite impressed. I think we loaded up a sell-side research report on one of our companies just to see how well this AI could summarize the gist of it, and they did a full 10-minute episode hashing down one of our companies and what the key points were about why it's a good investment, what are some of the risks. So I think for us it's not really a tool that we're using every day. I think down the road AI is going to be very powerful, and there will be some serious applications that will make all industries more efficient, and certainly the investment management industry will be one of those as well. But today, right now, in its current form, it's not really something that we will rely on, especially given that we're fundamentally driven investors. I would say maybe the answer is a little bit different if you're a quant shop and you just need AI to calculate some numbers or some parameters for you. But I think for us, we really value some of the qualitative aspects of the business, which may be hard to kind of rely on an AI to kind of give you insights in that regard. So that's my personal view. I don't know if Martin, maybe you might feel differently, but
I'm too old to know any better.
It's a novelty for now, right, gentlemen? It's interesting, but you're not relying on Gen AI to produce any new ideas or alpha for the fund. Let's talk about your favorite books of all time. If you were to name one book that you still go back to the bookshelf to maybe read every few years, what would that be?
Oh my God.
oh boy.
It wouldn't be an investment book.
Okay, well, tell us. What would it be?
Probably be a Russian novel. I have to read War and Peace again.
You know what's funny? Martin and I both we're both avid readers, but we don't tend to read books related to our business or business in general. You know, I think we both like to read stuff about political science, about history. I think we're both kind of history buffs, and you know what I find interesting is that, you know, a lot of people may find it hard to find a connection between reading about history or biographies and how that applies to investing, but I think there is a key benefit from that, in that, you know, if you read biographies of famous people, whether they're good leaders, military leaders, and the flip side is, you know, tyrants who were generally seen as bad leaders and, you know, had an empire and it crumbled. I think there's a lot of parallels that you can carry through to management teams and leadership in general. You know, even though these characters and these people may have lived, you know, 400 years ago or 300 years ago, I don't think human nature is that different from today, from how it is back then. And so you see these recurring patterns or characteristics in some of the most successful leaders in history. And you can kind of use that as a tool when you're evaluating management teams, and vice versa. There's certain patterns and behavioral characteristics that are found in terrible leaders over time, and I think there is maybe some application of that as well. So that's my kind of loose way of connecting books to investing. But yeah, generally, you know, I know when I was younger, you know, I used to read all the Warren Buffett books and still hold those near and dear to my heart. But I think just the environment and the way the market works now is a lot different than what the Warren Buffett books would tell you. So the one other great investing book was the Joel Greenblatt book. The Little Book That Beats the Market, where he kind of broke down investing to this magic formula, and it sounds all kind of neat and tidy, and I thought that was an interesting exercise, and probably is a very good accessible book, especially for people that are just starting out in the investment industry.
And for people just starting out, we'll close with this question for the, you know, do-it-yourself investor out there. What do they typically get wrong? What are the pitfalls?
So I think investing, personally, I think there's no right or wrong way to invest. There's a bunch of different ways that you can make money in the market, and the thing that investors get wrong is they don't focus on their sweet spot enough. You know, they try and do too many different things that are maybe outside of their core competency or outside of you know, what their personal skill set or personal temperament may permit. And we're of the view that everybody has a sweet spot, and the good investors are the ones that can identify what that sweet spot is, and then just repeat that over and over again. So, you know, I think, you know, it's no different than, you know, again, to use a baseball analogy, is just waiting for your pitch, you know, but you got to understand what your pitch is. What does that look like? And over time, if you swing at the good pitches and lay off the bad ones, that's, you know, generally a good formula for success. And, you know, I think even for us, looking back on this year, I think some of the positions that we had go wrong were probably some of those pitches down and away that we shouldn't have been swinging at. And whereas our biggest successes were, you know, the quote-unquote fat pitch down the middle. So I think that's something that investors really need to focus on, is finding that style or that type of investing that suits their skill set and their temperament. And the temperament part is important too, because a lot of this is behavioral. And so there has to be alignment with your strategy and the way you personally are, and your patience level and tolerance for volatility is also important. So that's my view. I don't know, Martin, if you feel
Yeah,
different.
I fully agree with everything Veeral said, and do what you're good at. Don't do what you're not good at. And one of the ways to figure out what you're good at and not good at is to look at everything you've ever done in terms of prior investments, the ones that worked, the ones that didn't work. Ask yourself, where did I get that idea from in the first place? Who gave me that idea? And where did I go wrong, or where did I go right? And then try to group them accordingly. The ones that all went wrong, they had one thing in common or two things in common. The ones that all went right, they had one or two things in common. If you can identify the critical success factors or lack thereof, you'll know going forward to avoid this, but to play on that. And so, that would be about all I could say, because as Veeral alluded to, there's just so many different ways of going about this exercise. It's far be it for us to tell people how to invest. We're just, we picked a lane, that's our lane, but that doesn't mean it's everybody's lane.
Yeah. Well, this has been a great conversation, gentlemen. Thank you very much.
Okay. Thanks for having us.